So in this class, I'm going to teach you a bunch of different ways that you can take profit so that you can maximize the profits you make on your positions and get better results in your trading. There are 3 ways that we can take profit on a trade. The first is just like this, the most simple. It's with a take profit level. An order that we place that will take us out of the markets in profit by selling our contracts into the market once price hits a predetermined level. So we would set this as our take profit. When the market price reaches this level, we're closed out, that's it. That's the most simple, common, and obvious. The second way is with a manual execution. So when the market reaches any price level, if we're holding a profitable position, we can make a market execution, which basically means we will click a button to sell our contracts back. So let's say we did that at this level here when the market was rallying. This is the second way to get out of trades. It's going to get us out at any level we decide. We don't predetermine a level, we just manually close the position when the market reaches a price that we like. And the third way is through stop loss trailing. So let's say we got into the trade at this level here. We ran the market up, it formed this new high, this new low. It then went up and formed this new high. What we would then do is get the stop loss that we have placed at this level and change the location of that stop loss. We could draw that stop loss up to, for example, this level here. And now if the market was to pull back and hit that level, we would be closed out of the trade. So we would be forced to take profits at this point. Now with stop loss trailing, we can actually follow market price with every new high and low that it forms so that we can get out at the optimal price. So this we kind of use as a safeguard to make sure that we don't turn winning trades into losses and to make sure that even when trades go against us, we are going to take at least a small profit from the market. Now let's go a bit deeper into the theories of taking profit, and I'll break all of these methods down in more depth. When we get into a trade, we always want to make sure our exit is going to be risk-reward positive, which basically means if we're risking $100 on a trade, we want to make sure we are going to gain back around $300 or more, which means that we can lose half the trades we take and still remain hyper profitable. Now, there are a few ways that we can actually get out of trades and decide where our take profit is going to be. Where you get out of a market is more important than where you get in because it determines whether you'll be profitable or not. So I'm going to show you a few tips you can use to decide the perfect take profit. Now for this hypothetical example, we traded into demand, we had a break in the internal structure, and we made our entry from this point here. Our stop loss is beneath the low at around 79 pips. And now we need to decide where to place our targets. Now, as we've said, we don't want targets to be too small, so we couldn't really target this immediate area. We would want to extend targets forward to try and get 3R. So this number here needs to be around 3. That's going to be optimal. If we can get that or more, we're in a very good position. So the first method to exiting trades profitably is just to target the next high or low. So just like this. Now in this trade example, we can see this market is clearly in an uptrend. Every time we push up, we form a new higher high, we form higher lows, okay? The market is clearly trending to the upside. So if we're buying from this higher low, we're pretty much sure, or we have a good indication that the market is at least going to take the next swing high. And the reason we know this is because in an uptrend, the market is going to continue to make higher highs and higher lows. So if our position is correct, it is highly, highly likely that the market trades towards that point just there. So that is the most simple way to choose your target for a trade. Just attack the next swing high in an uptrend, or attack the next swing low if you are selling during a downtrend. Providing you're moving with the trade, which we should almost always be doing with our positions, you have clear targets always. You just attack the next swing point, whether it's a high in an uptrend or a low in a downtrend. But if we know this market is likely to continue trading up, we may see this as a little bit of a limitation to our profits. Now, I've got no problem taking 3% profits on every single winning trade I take. But when there is opportunity to take the market even further, why not do that? So what we can do is actually start using past price action. So what this now entails is heading over to the left. We want to go this way in the chart and identify previous points that could potentially be used as targets. So here's a hypothetical example of using past price data. Now in the example that we just covered, we got into a position on the formation of the new higher low. And for our target, we just targeted the next swing high. So our trade was something like this, okay? Now that's solid as we've said, but if there's opportunity to take the markets further, we can do that. Now the 2 ways that we are going to be using to get out of trades are supply zones or demand zones, which we'll talk about in a moment, and swing highs and swing lows. So because we are in a bullish movement here, we're going to focus on supply and swing highs. Now, a swing high is just any high that's formed in the market. So realistically, this is going to be a swing high just here. Then we would also have another swing high just here. Basically, a swing is going to be a movement in the market, a leg of price action like this, or like this, or like this. So swing highs are pretty clear targets. The market, if it's in an uptrend, is going to attack those previous swing highs as it moves through its bullish trend. So the first initial thing we could do is extend the target further towards a swing high. But supply zones is where things really get interesting. So let's say we've moved over to the left and we see a large sell-off prior to the movements that we got into. If we have what we call an imbalance, so an open price range, and don't worry, I'm going to show you this on a real chart in a moment. If we have an open price range that leads into an area of supply, which is a consolidation before a downward move, click the card in the top corner of this video if you really are clueless about supply and demand. I'll teach you about that now. Well, these areas of supply with imbalances or open price ranges act as magnets for price. So if we were to use this as our take profit, focusing on seeing the market come up and retest this area of supply, we have a very clean and easy trade. And now if you understand supply and demand at all, you will know that supply zones are generally where we're going to start seeing selling in the market. So if we see a supply zone like this and we take profits there, we're in a good position because now if the market turns on us, we've already gotten out of our trade profitably. So going back to this previous trade example then, this is our simple swing high target. But if we want to extend our targets, we could simply look for areas to the left of price. So if we go to some past price action, we'll be looking for previous swing highs that could potentially act as targets for us. So by heading back in price, we can see that this area here is pretty much in line with our trade target. So this would be one swing high, but we don't need to worry about that too much because it's already been cleared by price action with the push higher. Now the next notable swing high that we're going to have in this market would be this high just here. This is a pretty significant swing high, meaning the market is likely to be driven towards this area. Now, another swing high we could focus on would be this next one, which is just above it. So it's very simple to actually identify swing highs that we can use for targets to trade. We just want to go back and look in the market in a phase where the market was potentially moving bearish, and then we use our buys to actually tackle these price areas. And as you can see, using these two swing highs as targets would have extended your trade up, first of all, to a 6.85R, which would be $685 for every $100 risked, and the second trade would be an 8.9R. Now, I am trading here on the daily time frame, but the concepts I show you can work just as well on the 1 minute or 5 minute. We will jump to an example of that in a little bit. So if you're a day trader, do not worry about the time frames, you'll be just fine. So there you can see, we have the initial swing high inside of the current trend. But if we go back and use that format we just looked at and use some of those previous swing highs in the market price, such as this swing high here and this swing high here, we can extend our targets pretty significantly. Now, in this instance, there wasn't really an area of supply, but sometimes there will be. So, for example, if there was a supply zone just here, instead of targeting the swing high, we'd look to target the lower boundary of that supply zone. Because that way, if the market was to trade into the area of supply and then reverse, we'd be getting out at the safest possible point so that the market doesn't completely flip on us. The next consideration is partial profit taking. So let's line up this setup we've just looked at. We talked about the first exit, which would be the simple swing high just here. But there is also the second swing high, and there is also the third swing high. So there's actually multiple levels that we could potentially get out of this trade. Now, of course, anytime we're in a position, there's risk of reversal. So it's possible the market could come up, sweep this high, and then sell off. If you were targeting your full position at the final high, you'd miss out on the entire movement and you'd end up closing the trade for break even or potentially with a trailing stop for a considerably smaller profit. Now we're going to talk about those soon. Don't worry if you're not well versed with that. But this is where partial taking comes in. Now you might see some traders talking about take profit 1, take profit 2, take profit 3. And when they say this, they're talking about partials. So a partial is simply where you close a part of your trade, okay? Partial profit taking. You don't have to take all of your profits at one level. Because when we buy an asset, we're buying contracts, we can close our positions at different price levels. So let's say we bought 100,000 contracts down here at our entry. Well, then we could close 33,333 contracts at this level. We could then close 33,300 contracts at the second level and the final 33,333 contracts at the final level, or we could call it 334 if we want to be correct about it. This would mean that we are taking profits in 3 sections. We have TP1, TP2, and TP3. It means that we would close a third of the trade at 3%, which means we would take 1% profit here. Now, we'd only have 2/3 of the trade running. So when we reach the 6.7% mark, we're actually running around 4.25% at this point, because a third of the trade has been taken off. But that means if we take half of the profit at this remaining level, we can take around 2.1%, okay? So we've got 2.1% profit taken at the second level. We've got 1% profit taken at the first level. And then if the trade hits the final point as well, we can take the remaining profit, which is going to be 1/3 of around 9%. That's going to be around a further 3%, okay? So now at this point, with this full take profit hit, which would be 8.94%, we've managed to take 6.1% from this move. Now, obviously, we have then chopped off around 2.8% from the potential on this trade. So we are eliminating 2.8% profit potential. But disregarding that 2.8%, what we've done here is safeguard our positions. Because if the market comes to the first take profit and then reverses, well, at least we still made 1% on the move, which wouldn't have been made if we were holding out. If the market hit the second level and then reversed, rather than getting closed out at nothing or nearly nothing, we'd be able to take 3.1% on this trade. And then, of course, if the target does make it all the way through, yes, we've sacrificed 2.8% in profits, but we've managed to reach the target in the safest possible way, and we still close up over 6% with this full movement. Now, there are benefits and drawbacks to partial taking. I'm going to talk through the alternative to partial taking, which is stop loss trailing. It's possible to use them in conjunction, but basically, your partial taking is an insurance policy that even if the market reverses at one of your given levels, before reaching your final target, you'll still be able to get out profitably. Okay, now we're going to discuss manual executions. This is where we just click a button to get out the trade at any given price point. Generally, we try to not do this because if we manually execute all of our trades to get out of them, we're going to end up just closing our trades early. Now, one problem that traders have is when a market is moving in their favor, they panic that it's going to reverse and they get out too fast. And then their risk reward is limited to 1% or 2% instead of 3 or 4 or 5, which means it's hard to stay afloat when losing trades come around, as they inevitably will. There is only really one point where we will want to get out of trades, and this is dynamic risk reward situations. So manual executions, exits to your trades are going to be reserved to situations with dynamic risk reward considerations. So what is this then? Well, when we're in a trade, we have risk reward to consider. So this trade, purely hypothetical, don't worry about entries. We're just going to talk about the theory, okay? So this trade has a 6.96% return, 6.96 R. That means if the trade wins with $100 risk, it's going to make $696 in return. That's a nice profit. But what happens if the market comes up to very close to your target like this, but then starts to reverse on you? Do you hold this all the way through to your target? Or is it sometimes okay to make an early exit? Now, some traders will tell you you should always 100% wait for your target to be filled. And this is okay, right? But if we're at a point where the market starts to lose momentum and we are considerably close to the target, we start to see reversals like this, I consider the dynamic risk reward. Now, we take a look at the position as to where it is right now. It's at 5.27%. If we fill the target, we will make 6.96%. So we're looking to risk here 5.27% to make around 1.7%, okay? So if we consider the dynamic risk reward, we are now incredibly skewed. We pretty much have all of this at risk for only this as a target, right? That's the only potential that this trade can give us. Now, obviously, in some situations, the market will then just rally straight through to your target and all will be well. But in other situations like the one you're watching now, the market reverses all the way. And because you were pushing for that final 1.27%, you end up missing out on the entire position. You end up getting closed out at break even or potentially even a loss if the market reverses enough. So I consider the dynamic risk reward in positions like this, and providing I'm trading over 3% in returns, meaning I'm looking at a 3R trade or higher, and the market is trading considerably close to my target, well, if we start to see reversals there, and I see reasoning for the market to not fill my target and instead reverse, as we've seen here, then I am happy to get out of positions a little bit earlier. This is a personal strategy thing. You don't have to agree with this, but I'm just putting the idea forward for you to go and backtest for yourself, because this has saved me and made me a lot of money over my trading. What you don't want to do is consider this dynamic risk reward thing super early. So if the market is up to this point, you don't want to think, well, now I'm risking 2% to make 6%, or now I'm risking 3% to make only 4% more. You don't want to think about things too early, because it's going to give you an excuse to get out of your trades, even though they really have a lot more movement in them. But if you are trading considerably close to your target, and then the market starts to give forms of rejections, I mean, even like this, for example, we start to see wicks forming this close to the target, you could take 6.42%. The difference between 6.42 and 6.95 is not much. You're risking here 6.5% to make 0.5% in returns. In my opinion, it is completely justified and fine to close a trade this close to the target if you start to see first signs of rejections. So if your trade is pretty much tickling the take profit level, as it is in the examples we've seen here, I like to consider this dynamic risk reward and sometimes get out of my positions early. Now, if the trade is moving with considerable momentum, such as if we'd seen a continuation of these very strong candles, then it would be fine to leave the market to trade all the way through. But when we see this considerable gap down here and the start of these bearish candles and complete lack of now bullish momentum coming in at this point, it's around this point where I'd consider, look, I can take 5.5% return here, which is an incredible return, and I don't have to risk all of this profit just to make an extra 1%. So that is one of the only situations where I'd be looking to get out of trades early as manual executions. Another would be time of day. There is another way to get out of your trades profitably, and that is by getting stopped out. Now, hear me out, that sounds confusing, but I'm going to show you what I mean. So here we have an example. Once again, do not worry about the entry. We are talking theory of taking profits in this video. Trade context does not matter. But as we discussed previously, we have this supply zone here to the left. We're using past price action. This supply zone being imbalanced is going to be the target for our trade. So we are hoping that this market continues moving all the way up towards this point. Now, one thing we can do with our trades is have contingency plans, and that is stop loss trailing. That is where this theory comes in. Contingency plan is basically an exit plan, a backout plan. If things don't go your way, how are you going to get out of this trade? The first contingency that we employ is having a stop loss on all of our positions, as I hope you do by this point in your trading journey. We enter a trade, we have a stop loss. But this stop loss, as we mentioned briefly towards the start of the video, can be utilized to also take profits. So when the market is moving a reasonable distance away from your entry, what you can do is put your stop loss to break even. So if this is our stop loss level just here, we could actually drag this up towards the break even point when the trade is running. Now, a stop loss is not going to make sure we profit, but it's going to make sure we don't lose. Okay, we cannot lose here if the trade gets closed at break even. Now, the stop loss trailing methodology comes in once the market starts to make favorable structural movements. So as we can see here in this market, we have our low. We've had a push away, we've formed this high. We have come down now, and we have formed what could potentially be a higher low, which would be this level just here. I say it could potentially be because to validate a higher low, we now need to make a new higher high. Okay, if this high gives way to price and a new high forms in the market, then this level here is validated as our higher low. So let's see what the market gets up to at this point. As we can now see, we have a push and we had a little closure above that high. If we wait a little bit longer, we get a more significant closure above. So with some more significant closures above this high, we've now validated that this level here is a new high in the price move. So what we can do at this point is actually trail the stop higher. So this being our stop loss could now be dragged up to underneath the previous structural low. So if we consider the market structure now, we have a low, we have a high, we have a higher low, we have a higher high. If this trend stays intact, there is no reason for the market to come down here. And unless the trend stays intact, bullish, we don't want to be in this trade. Because obviously if the trend reverses, it's going to go against us. It's going to be moving in a direction that we don't want to be moving in. So at this point, we now have our stop loss locked into profit. So the best case is that we win the full trade, but the worst case is we make 0.3%. Now 0.3% is nothing to get too excited about, but you'll see as we go on how this theory continues. We see the market pull back a little bit, and then when the market pushes up to form a new higher high, which means the market would have to now break this high. That would open the doors to us leading our targets a little bit further, leading that trailing stop a little bit further even, and bringing it up towards the previous higher low. So this is going to be our confirmed higher low because this is our confirmed higher high. So now we are actually looking at making around 1% if the trade goes against us. Best case, we get our full take profit, but worst case, at least we're making a little something. When a trade gets considerably closer to the target, such as in this instance where we're now considering that dynamic risk reward, if we are seeing momentum as we are, what we could start to do is aggressively trail. Okay, because at this point, we're moving pretty far. At this point, I believe we are looking at pretty much risking 4.5% here to make that final 1.2%. So we can hold the trade if we want to, but we shouldn't really allow this to come all the way back to the 1% mark because that would not be great. It wouldn't feel great if we lost out on 3.5% or more by holding this position. So now we can start aggressively trailing. With aggressive trailing, what I do is move stop losses under the previous candle. So when this candle closes, we can place our stop beneath it. This way, if the market reverses, we immediately get taken out the trade. And at least then we are taking home over 3% on this trade, which is enough to be happy with. If we then went and pushed a new candle, once that candle closes, we can once again follow that candle with an aggressive stop loss trail. If the market then pushes even higher towards the target, happy days. But if it starts to reverse, at least we are getting out. And in this instance, that's what happened. So we're taking a 3.76% profit on this trade. But just look how it played out from there. We ended up moving all the way back down to the entry. And had we not trailed the stop here, we would have missed out on all of this profit just because of this tiny little movement. Now, if you use the second tip I gave you in this video, it's possible you got out here pretty much at the full target using that dynamic risk reward theory that we discussed. But if you didn't, at least you're taking 3.7% home instead of giving it all away and ending the day very upset. So that's it. That is the ultimate guide to taking profit on your positions. If you follow these three methods or just pick out the ones that you think will be useful to you, then I'm sure you can make more money from your trades. Now, if you want to learn how to build a trading system, including some of what I've taught you today, there's a free course. The top link in the description will take you to that. 100% free. You can get instant access and it's going to help you to build your first successful trading strategy. So check that out. Thank you for watching. If you don't want to watch that, check out this video next. That will follow on nicely from this one and I'll see you in the next video.